Welcome back to the NexCrypt, your go-to channel for deep dives, sharp analysis, and future-focused content on everything crypto. In a market overflowing with projects promising the moon, it's tough to separate true innovation from overhyped noise. But every once in a while, a project emerges that doesn't just follow the trends, it aims to redefine them. Imagine you're about to make a trade on a decentralized exchange. You've done your research, checked the charts, and everything looks perfect. You hit swap and wait for confirmation. But by the time your transaction is confirmed, something strange has happened. You receive fewer tokens than expected, or you paid a higher price than what was initially quoted. You might shrug it off as market volatility. But what if I told you that this wasn't just bad luck? That someone, somewhere, somehow, saw your transaction before it was confirmed and exploited it to make a profit at your expense? Welcome to the shadowy world of MEV, maximal extractable value, a high-stakes battleground where bots, miners, and validators play financial chess on-chain, front-running your trades, sandwiching your transactions, and bleeding users dry through something as subtle as slippage. This isn't some glitch or bug. It's a deeply rooted issue baked into the very structure of blockchain networks, and it's happening every second in the mempool, the public waiting room where every transaction lingers before being permanently etched into the blockchain. Here, nothing is secret. Everything is up for grabs. And if you're not careful, your wallet becomes an open opportunity for someone else's gain. In this deep dive, we'll uncover what MEV really is, how front-running and sandwich attacks work, and why slippage isn't just an annoying part of crypto trading. It's a signal that you're operating in a financial Wild West. We'll break down the mechanics, expose the strategies used by bots and validators, and most importantly, show you how to protect yourself. If you're serious about DeFi, this is one rabbit hole you can't afford to ignore. Because the truth is, in the world of decentralized finance, the game is often rigged, and it's time you learn the rules. 1. Understanding MEV, the hidden force in blockchain transactions. In the world of decentralized finance, DeFi, and blockchain technology, a term that frequently emerges in technical discussions is MEV, or miner extractable value, now more broadly called maximal extractable value. At its core, MEV refers to the extra profits that validators, block producers, or miners can capture by manipulating the order and inclusion of transactions within a block. This phenomenon is not just a technical curiosity, it is a critical piece of the infrastructure puzzle that shapes how decentralized applications, dApps, decentralized exchanges, DEXs, and DeFi protocols operate under the hood. MEV was first discovered on Ethereum, where the way transactions are organized in a block can drastically impact their outcome. Miners, or now validators, especially in proof-of-stake systems, have the power to reorder, insert, or censor transactions, and this allows them to exploit profitable opportunities, often at the expense of ordinary users. For instance, if a user submits a large trade that is likely to move the price of an asset, a miner might notice and place their own trade ahead of it to profit from the price change. That difference, the profit made purely from transaction manipulation, is MEV. As DeFi continues to grow and attract billions in liquidity, MEV is becoming increasingly relevant. It represents a form of value extraction that isn't always fair, and in some cases, it can even destabilize protocols. While it's a natural outcome of open, permissionless networks, its ethical and economic implications are still hotly debated. Solutions like flashbots and MEV auctions have emerged to make MEV extraction more transparent and less harmful. But the fundamental incentives remain. Anyone transacting on-chain should be aware that their transaction is not just a simple exchange. It's part of a larger battlefield where bots, miners, and algorithms compete for profit. Second, front-running in DeFi, the race against the blockchain. Front-running is one of the most well-known manifestations of MEV, and it operates similarly to insider trading in traditional finance. But on the blockchain, it's driven by algorithms, bots, and network mechanics rather than human brokers. In its most basic form, front-running occurs when someone observes a pending transaction in the mempool and places a similar transaction with higher gas fees to be processed first. This is made possible by the transparent nature of blockchain networks. Before transactions are finalized and added to a block, they sit in a queue called the mempool, where they can be seen by anyone, including bots and miners looking to capitalize on user activity. Suppose a user is about to purchase a large amount of token A on a decentralized exchange. A front-running bot detects this pending transaction and quickly places its own buy order with a higher gas fee. The miner, incentivized by higher fees, includes the bot's transaction first. As a result, the bot buys the tokens at a lower price and sells them moments later after the user's larger buy has pushed the price up. The bot makes a profit, but the user ends up buying at a worse price, paying for the opportunity that the front runner capitalized on. This creates a serious fairness issue in DeFi, where the most sophisticated actors with the fastest bots and the most aggressive fee strategies win, while average users pay the price. It's not just an inconvenience, it's a systemic issue that discourages participation and trust. In traditional markets, front-running is illegal because it exploits privileged access to trade information. But in DeFi, where transparency is a core principle, that information is available to everyone, so the exploitation is technically allowed, even if it's ethically murky. Developers have attempted to design systems to protect users, like private transaction relayers or encrypted mempools, but the race between offense and defense is ongoing. Front-running is a reminder that while decentralization offers openness, it also opens the door to aggressive strategies that can hurt the average participant if safeguards are not in place. 3. Sandwich attacks, exploiting the middle for maximum profit. One of the more advanced and predatory forms of MEV exploitation is known as the sandwich attack, a strategy commonly used in decentralized exchanges where trades are visible before execution. A sandwich attack involves placing two transactions around a target user's trade, one just before and one just after, to exploit slippage and price movement. Here's how it works. Imagine a user is attempting to buy a large amount of a token, which will inevitably raise its price due to how automated market makers, AMMs, like Uniswap calculate prices. A bot sees this trade in the mempool and initiates a buy order before the user's transaction, causing the price to rise. Then after the user's trade is executed at the now higher price, the bot immediately sells the same tokens at the inflated rate, capturing profit. The user ends up with a worse exchange rate, essentially becoming the middle layer of the sandwich, squeezed by two trades that manipulated the price before and after their own. Sandwich attacks can be very profitable for bots and arbitrageurs, but harmful to users and the ecosystem. They exacerbate slippage, cause unexpected price movements, and reduce the efficiency of decentralized markets. These attacks thrive in transparent, open blockchains where the order and content of pending transactions are public knowledge. What makes sandwich attacks particularly insidious is that they often go unnoticed by users who may assume they simply got a bad deal or that market volatility is to blame. But in reality, it was a calculated strategy exploiting the mathematical design of liquidity pools. Some platforms are fighting back with innovations like transaction batching, gas price caps, and privacy-preserving transaction systems. But these are far from foolproof. In some cases, even the tools designed to combat MEV are co-opted by sophisticated bots. Ultimately, sandwich attacks highlight the need for user education, better protocol design, and possibly regulatory frameworks to ensure that the decentralized markets of the future are not dominated by a handful of well-equipped predators gaming the system. 4. Slippage, the hidden cost of blockchain trading. Slippage is an essential concept for understanding why MEV and related attacks are so profitable, and how users unknowingly lose value. In trading, slippage refers to the difference between the expected price of a trade and the actual price at which it is executed. On decentralized exchanges, slippage often occurs due to the automated nature of market makers and the real-time volatility of crypto assets. Unlike centralized exchanges that match buyers and sellers, DEX use liquidity pools and pricing algorithms. This means that the larger your trade, the more you impact the price, especially in low liquidity pools. Slippage becomes an opportunity for MEV bots because any large trade that moves the price can be exploited. For example, if you're buying a large amount of token B and expect to receive it at $10 per token, but your trade ends up being executed at $10.30 due to slippage, that 30 cents per token difference can be skimmed off by bots who front-run or sandwich your transaction. This is how traders end up paying more or receiving less than intended. Most DEX allow users to set a slippage tolerance, the maximum amount of price movement they're willing to accept before the trade fails. If a bot causes the price to move more than this percentage, the transaction reverts. However, users often set high tolerances to ensure trades go through during volatility, unknowingly opening themselves up to predatory MEV strategies. Slippage is also affected by network congestion, gas prices, and trading volume, making it unpredictable. While slippage might seem like a small inefficiency, across billions of dollars in daily volume, it adds up to significant losses, especially for retail traders. MEV bots feed on slippage, turning it from a market quirk into a systematic opportunity. Tools like slippage protection algorithms, trade simulations, and private order routing can help reduce these losses, but they require awareness and technical know-how. For the average user, slippage remains a silent tax on every trade, and unless the ecosystem evolves to protect them, many will continue to pay more than they realize. Ultimately, slippage is not just a technical footnote. It is a crucial part of the MEV equation and a battleground in the fight for fairer blockchain finance. At the NexCrypt, we're not here for hype. We're here to uncover real innovation, challenge the noise, and keep you ahead of the curve. If you found value in today's breakdown, make sure to like, subscribe, and hit that notification bell so you never miss an opportunity to decode the future of crypto. Got thoughts on this project? Think it's revolutionary or overrated? Drop your take in the comments below. Let's keep the conversation going. Until next time, stay curious, stay sharp, and keep it crypto. This is the NexCrypt, signing off.